Good afternoon, everyone, and welcome to this online presentation of our November 2020 Economic and Fiscal Outlook. Thank you for joining us. I'm going to take you through the highlights from our latest forecast, and then we'll go into an online question and answer session. If you'd like to ask a question at any point, please use the Q&A feature, and we'll try to answer as many as possible. Please give your name and institution. My slides and speaking notes will be on the website at the end of this event. This is my first forecast since taking over from Robert Choate as chairman of the OBR last month. I'd like to start by thanking Robert for all that he's done to establish, build and lead this important institution over the last decade. I'd also like to thank my colleagues Charlie Bean and Andy King, the staff at the OBR, and numerous officials across government, including for the first time government scientists and public health experts, whose insights were invaluable in helping us to assemble this most challenging of forecasts. But I should stress that all the assumptions, analysis and scenarios we present today are our own. It's now almost a year since coronavirus arrived on our shores, but the course of the pandemic remains the most important determinant of our economic and fiscal prospects. And while we've had encouraging news about several vaccine trials in recent days, there remains considerable uncertainty about how effective those vaccines will prove to be in not only preventing infection, but also transmission of the virus, and how quickly they can be rolled out to the general population. In light of this continued uncertainty, it would be misleading to rely upon a single central forecast to describe the current economic and fiscal outlook. Part of the role of official forecasters like us is to find ways to communicate the risks around that outlook, so that the public, parliament and policymakers can make decisions that are robust to a range of possible futures. For this reason, as in our fiscal sustainability report back in July, we continue to present several possible scenarios for the economy and public finances, conditioned on different assumptions about the future course of the virus, stringency of health restrictions, and the availability of potential vaccines. All of these scenarios assume that the UK successfully concludes a free trade agreement with the European Union prior to the end of the transition period in 5 weeks' time. However, because negotiations remain ongoing and may not ultimately prove fruitful, we also present an alternative scenario in which our relationship with the EU defaults to World Trade Organization terms from the 1st of January. We estimate that such a no-deal outcome would reduce the level of UK GDP by around 2% and increase borrowing by around £10 billion compared to the figures you're about to see. The details underpinning these estimates can be found in Annex B of the EFO document. Given the importance of understanding what we've been through this year to projecting where we may be headed over the next 5, let me start with an account of how our lives, economy and public finances have been upended since we first published our last economic and fiscal outlook back in March. The UK was one of the countries hit hardest by the initial wave of the pandemic, seeing one of the highest rates of hospital admissions and third highest fatality rates in Europe, as shown in the chart on this slide. And as cases in this country mounted, the Prime Minister announced the first national lockdown on the 23rd of March, shuttering businesses, schools across the country over the months of April, May and June, one of the longest lockdowns in Europe during the first wave of the pandemic. Both because of the severity of the outbreak here, and is shown in the chart on the left, Both because of the severity of the outbreak here, and is shown in the chart on the left, we locked down harder and longer than most other countries, and as a result the UK suffered one of the largest falls in output during the first wave of the pandemic. And as shown in the chart on the right, UK GDP fell by 22% in the first half of this year, the sharpest contraction of any major economy other than Spain. But as case numbers fell and public health restrictions were lifted over June and July, economic activity rebounded strongly over the summer, and as you can see from this chart, output recovered from being 26% below its pre-virus peak in April to being just 9% down by September. The recovery from this first lockdown was faster than predicted in our July FSR, though not as fast as witnessed in some other European countries. Throughout the first lockdown and subsequent recovery, employment, earnings and consumption were supported by an array of government interventions unprecedented in their scale and scope in peacetime. With around 9 million on the furlough scheme and another 2.5 million on the self-employment scheme, about 1/3 of the total workforce have benefited from direct government support at some point over the last 8 months. Support for firms has also been substantial, with well over 1 million taking out government guaranteed loans, while those in the hospitality sector have benefited from a 15% cut in VAT and the Eat Out to Help Out scheme in August, amongst other things. And while unemployment has crept up from 4% at the start of this year to 5% in September, these schemes have helped stave off what would have been a far bigger rise in worklessness. And business support measures and forbearance by creditors has also helped employers stay liquid during this period, with the number of company insolvencies actually running 1/3 lower than normal for this time of year. However, a resurgence of infection rates and the reimposition of tiered health restrictions in different nations and regions of the UK took the wind out of the recovery at the end of the summer, with the economy growing by just 1% in September, and real-time mobility indicators, like the ones shown on this slide, suggesting that economic activity contracted as cases rose through October. Further tightening of health restrictions over October and the imposition of a second national lockdown on the 5th of November is expected to drive growth back into negative territory this quarter. However, because schools remain open and many businesses have adapted their workplaces to make them COVID safe, we expect the reduction in output during the second lockdown to be only 60% as severe as that experienced during the first lockdown, leaving GDP 15% below its pre-virus peak this month. From here on, the economic outlook depends crucially on the answers to three epidemiological questions. First, how effective will the second national lockdown be in reducing case numbers to manageable levels? Second, what general level of public health restrictions will be needed to control the virus after lockdown ends on the 2nd of December? And third, how effective will new vaccines be, and when will they be available to the general population? Different answers to these questions provide the basis for our three scenarios for the path of the economy over the next 5 years. And I should emphasize that our forecast was closed before the government made its latest announcements regarding revisions to its tiered health restrictions. So tier numbers mentioned here in these scenarios relate to the regime as it existed before the 5th of November, not as was announced by the Prime Minister on Monday. Our upside scenario assumes that the current lockdown substantially reduces the number of cases by the time it's lifted on the 2nd of December. Thereafter, an effective test, trace and isolate program allows for a substantial loosening of public health restrictions to an average level equivalent to Tier 2 under the pre-lockdown regime. An effective vaccine becomes widely available in the spring, permitting a further easing of health restrictions and a rapid return to relative normality by the end of next year. In our central forecast, lockdown also ends on the 2nd of December with a higher residual infection rate and less effective test, trace and isolate regime, which requires a more stringent set of public health restrictions, on average equivalent to Tier 3 under the pre-lockdown regime, to remain in place until spring. The arrival of warmer weather then allows for an easing of those restrictions until an effective vaccine becomes available in the latter half of next year, permitting a slower return to normal life than in our upside scenario. In our downside scenario, continued high infection rates at the end of the current lockdown mean that an ineffective test, trace and isolate regime must be augmented by a tighter set of public health restrictions, on average than was in place prior to the 5th of November, to keep the virus in check through the winter. The arrival of spring permits some easing of those restrictions, but unlike in the other scenarios, no vaccine proves to be effective in stopping the spread of the virus. So subsequent waves of transmission necessitate a periodic reimposition of further national lockdowns. And the continued risk of infection requires more lasting changes in the conduct of our economic and social lives. This next set of slides shows you what these different scenarios imply for the path of the economy over the next 5 years relative to our March and July forecasts. In our upside scenario, output rebounds to pre-virus levels by the end of next year, and its pre-virus path by the end of the lockdown period, with no long-run scarring of the economy. In our central forecast, there's a more gradual return of economic activity to its pre-virus level at the end of 2020, and the longer period of low investment and higher levels of worklessness take their toll on long-run supply, which remains 3% below our March forecast. And in our downside scenario, economic activity does not regain its pre-virus level until the end of 2024, and remains 6% below its pre-virus path, reflecting the loss of productivity from the adjustments to economic and social life necessary to keep the virus under control in the absence of an effective vaccine. Let me now turn to the implications of these different scenarios for the labour market. In the upside scenario, the extended furlough scheme provides an effective bridge to a rapidly recovering economy, boosted by the rollout of vaccines in the spring. The employment rate ticks up to just over 5% in the second quarter of 2021, but falls back quickly to its pre-virus level, as those looking for work are reabsorbed by an economy which can make ready use of their skills and experience. In our central forecast, unemployment peaks at 7.5%, and then falls back more slowly to a slightly more elevated level by the end of the period. This higher level of unemployment reflects the longer stretch of depressed economic activity, resulting in a greater number of firm failures and loss of skills matches between employer and employee. It also reflects the significant gap in time between the current deadline for the ending of the furlough scheme in March and the turnaround in economic activity, which in this scenario gathers pace mid-summer. In the downside scenario, unemployment reaches 11% and falls back slowly to 5.25% by the end of the forecast, still 1.25 percentage points above its pre-virus level. This reflects the greater reallocation of labour between sectors necessary to adjust to a more socially distanced economy. However, in all of these scenarios, unemployment remains below the 12% peak reached in the wake of the recessions of the early 1980s. So what does this all mean for the public finances? In the UK, as in many other countries, coronavirus has prompted an expansion in the size of the state, an extension in the scope of its activities unparalleled in peacetime. Among 35 advanced economies, the UK has seen the second largest increase in government spending as a share of GDP, rising by 14 percentage points this year, compared to an average of 8 percentage points across advanced economies. To finance this dramatic increase in spending in the face of falling revenues, UK government borrowing this year is forecast to rise to £394 billion in our central forecast. This is 7 times higher than the £56 billion we borrowed last year, twice what we borrowed at the peak of the financial crisis, the second largest increase in borrowing in the G7, and the highest recorded borrowing since the height of the Second World War in 1944. And the cost of the pandemic has mounted over the course of this year, as the second wave of infections taken hold, health restrictions have tightened, and government support for workers and firms has been extended. This chart shows how the latest forecast for borrowing this year compares with those we made back in March, before the pandemic arrived in full force in this country, and in July, in the wake of the first national lockdown. It shows that at the time of the March budget, we forecast that borrowing would be £55 billion this year. By July, our FSR projected it to reach £370 billion, with about 40% of the increase in borrowing due to the impact of a smaller economy, and 60% due to the cost of the government's policy response as it stood after the Chancellor's summer economic update. Since then, the economy and tax receipts performed better than we forecast, and some policy measures have turned out to be less costly than we initially expected, saving around £40 billion against our July forecast for borrowing this year. But the cost of policy measures announced since July, including the Chancellor's spending review today, add a further £60 billion to government borrowing, £85 billion for their direct cost, with £25 billion coming back via the boost they provide to the economy. That takes the total borrowing for this year to £394 billion, or around 1/5 of the economy. And unlike during the financial crisis, where the consequences of the economic downturn for receipts dominated the increase in borrowing, most of the rise in the deficit this year comes from the direct cost of government policy interventions. And these measures have been announced in a succession of 14 policy statements over the course of the last year, each carrying a price tag of £20 billion on average, and each of which would have constituted a substantial budget in its own right in normal times. Looking at the composition of the £280 billion in government support, just over half has gone directly combating the virus, through higher spending on the NHS and related public services. 1/4 has gone on the furlough scheme and income support for the self-employed. Another 1/4 has gone to support businesses in the form of grants, guaranteed loans and tax reliefs. And the remaining sum has gone on things like boosting universal credit awards, taking over the railways, and topping up local authority funding. Of course, these policies have helped to avert a potentially much larger indirect cost to the public purse, which would have come from letting unemployment and incomes go into freefall as a result of the first and second lockdowns. With that as an account of the large but largely temporary near-term cost of coronavirus, what medium-term damage might the pandemic do to the fiscal position? Well, using the scenarios I outlined earlier, the EFO also presents 3 scenarios for the path of the public finances over the medium term. In our upside scenario, borrowing falls back from a peak of 17% of GDP this year to 1.7% in 5 years' time. This is around 0.5% of GDP below our pre-virus forecast in March, thanks to lower interest costs and also the £10 billion cut to non-COVID spending totals announced in today's spending review. In our central forecast, borrowing falls from 19% of GDP this year to 4% of GDP by the end of the forecast period as temporary policy costs abate and the economy recovers. But borrowing 5 years from now is around £40 billion higher than our March forecast, reflecting the 3% long-run loss of output and a somewhat larger hit to tax revenues in this scenario. Finally, in our downside scenario, borrowing peaks at 22% of GDP this year and then falls back more slowly to 6% of GDP, due in part to the additional fiscal costs of responding to a third wave of infection, and mostly due to the greater degree of economic scarring in this scenario. To illustrate what drives the change in borrowing relative to our pre-virus forecast in March, this chart breaks that difference down into changes arising from the economic forecast and changes arising from discretionary policy decisions. You can see that most of the increase in borrowing this year and next is due to government policy measures to combat the virus, shown in dark blue, with the impact of the recession on tax revenues shown in red and welfare spending shown in yellow making up the remainder. The direct costs of the virus fall away from 2022-23 as COVID-related spending is withdrawn, while the scarring effect of the virus on the economy and receipts remains. This is slightly offset in each year by the Chancellor's decision in this spending review to take around £10 billion of non-COVID spending relative to totally set in March out of their budgets, which accounts for most of the small green bar on the bottom of the chart. Let me now turn to the specifics of the 2020 spending review announced by the Chancellor earlier today, the financial implications of which have been reflected in our forecast. Looking at the detail of the spending review outcome for different departments, a total of £46 billion was added to departments' budgets next year, which is just over a third of the £125 billion added this year. Of this, £56 billion was directly linked to the fight against COVID across 11 out of 23 major Whitehall departments. However, as I mentioned, these increases are partly offset by the £10 billion reduction in business as usual spending. And while the Treasury has not stated explicitly where these savings come from, they have announced alongside this decisions to cut overseas aid from 0.7 to 0.5% of national income and a freeze in public sector pay outside the NHS and the lowest paid. And apart from the Foreign Office, which owns the overseas aid budget now, all departments see real terms growth in their resource budgets next year, with the biggest winners in real terms being the Reserve to pay for as yet unknown COVID costs, DEFRA to take over the Common Agricultural Policy from Brussels, and Transport to take over the railways. Capital spending is little changed since the March budget announced big rises in government investment over the next 2 years, bringing it up to a historically high 3% of GDP, and supporting the economic recovery shown in our forecasts. And while no detailed spending plans are provided beyond next year, we can estimate what the combination of the government's multi-year commitments in the areas of health, schools, defence and aid imply for other government departments' budgets in the 2021 spending review. Within the £397 billion total, for which plans need to be set in 2022-23, £143 billion has already been allocated to the NHS, £52 billion to schools, £32 billion to defence, and £7 billion will be needed to keep aid spending at 0.5% of national income. This leaves £163 billion to be allocated to the remaining government departments, which, as this slide shows, would imply spending on those unprotected public services being broadly frozen in real terms per capita in 2022-23 relative to the previous year. Were the government to wish to return overseas aid back to 0.7 of national income once the pandemic is over, but keep total spending the same, this would entail a 47% real terms increase in the aid budget, which in this chart is literally off the scale. And it would also require a 1.9% real terms cut in per capita spending for all other government departments. With such stark trade-offs in store for the next spending review, it's perhaps not surprising that the government's taking public expenditure planning 1 year at a time. Let me turn now to the longer-term legacy of the pandemic for the public finances. The stock of government debt is set to rise by 20% of GDP this year, and to exceed 100% of GDP in every year in our central forecast. Debt stays just below the 100% mark in our upside scenario, thanks to a more rapid recovery in the economy, and falls back more decisively at the end of the period to 90% of GDP. In our downside scenario, debt rises above 120% of GDP and stays there for the remainder of the next 5 years. Comparing our latest central forecast for debt with our pre-virus forecast in March, of that 27% increase in GDP and debt this year, 10% of that increase is due to a weaker economy, shown in blue, 11% is due to the fiscal policy measures announced since the budget, shown in red, and 6% is due to the temporary effect of the Bank of England's additional quantitative easing and term funding schemes, shown in yellow, whose unwinding allows headline debt to fall as a share of GDP in the last 2 years of the forecast. However, if one excludes these temporary balance sheet neutral transactions by our central bank, underlying debt rises as a share of the economy in every year, in both our central forecast and in our downside scenario. At the same time, despite the government's higher stock of debt, the cost of servicing that debt actually falls to new historic lows as a share of government revenue in our central forecast. This is thanks to further rounds of QE and further falls in interest rates since the start of the pandemic, reflecting the relative attractiveness of gilts as a safe harbour asset in the midst of the COVID storm. But while the overall cost of servicing the government's debts has fallen, the public finances have in the process become much more sensitive to further rises in interest rates. This is due to a combination of factors, including first, the 20% of GDP increase in the total debt stock. Second, the government's decision to shorten the maturity of its primary issuance this year. And third, and most importantly, the impact of the Bank of England's expanded QE operations, which swap an additional £440 billion of long-dated government gilts for floating rate central bank reserves. The combined effect of these three factors has been to increase the share of our outstanding debt with a maturity of less than 1 year from 1/4 a decade ago to more than a half today, and to double the sensitivity of debt interest costs to changes in short-term interest rates. So where does this leave the government relative to the various fiscal rules and targets that it set itself? Well, the OBR has a legal obligation to assess whether the government has a more than 50% chance of meeting its fiscal rules based on our central forecast. This presents a continuing challenge, as the set of fiscal rules currently on the statute books was set by Philip Hammond in his first autumn statement in November of 2016. Since then, the Conservative Party included a new set of fiscal rules in their 2019 election manifesto, but these were superseded by a review of the fiscal framework announced by the new Chancellor in March. The conclusions of this review have been postponed while the government deals with the pressures of the pandemic, and the Treasury has effectively stopped trying to chase any particular fiscal targets until virus-related uncertainties recede. But for the record, our latest EFO shows that none of the fiscal rules currently on the statute books are met, while 2 of the 3 rules in the Conservative Party manifesto are met based on our central forecast. But more recently, the Chancellor in his October party conference speech stated his determination to balance the books and get debt under control once the pandemic had run its course. So for completeness, we also look at the degree to which different interpretations of these goals are met over our forecast horizon. Looking at 3 conventional definitions of fiscal balance, the headline deficit, primary deficit, and current budget deficit, none of them are achieved on our central forecast by the end of the forecast period. Matching day-to-day spending to receipts, the loosest of the 3 definitions of balancing the books, would require current spending cuts or tax rises of £27 billion in the final year of the Parliament based on our central forecast. And depending on the scope of liabilities and assets taken into account, the government fares better in getting debt under control by the end of the Parliament. Headline debt falls at the end of the forecast period by 0.3%, but as mentioned earlier, this is only because of the unwinding of the Bank of England's term funding scheme. Excluding the help offered by the bank, underlying debt rises by 0.8% of GDP. Getting it to fall on our central forecast by the end of the period would require spending cuts or tax rises of £21 billion on our central forecast. However, if we look at public sector net financial liabilities, a broader measure of the balance sheet taking account all the government's financial assets and liabilities, it would meet this goal by more than 1%. So let me conclude. The country has already paid a heavy economic and fiscal price as a result of the coronavirus pandemic. The analysis we're publishing today lays bare these costs, which are now being compounded by a second wave of infection. But the news from recent days regarding the effectiveness of several candidate vaccines has also provided us for the first time with a credible basis for forecasting a more lasting economic recovery, motivated by something more than just our innate hopefulness and faith in the miracles of science. But much remains uncertain, and our scenarios illustrate several possible paths for that recovery, some of which are longer, rougher, and more costly than others. Which of those paths we take depends crucially on how effectively 3 elements of the government's public health response, lockdown, test and trace, and vaccine rollout, can work together to permit a safe and steady recovery in economic activity back toward pre-virus levels. And the economic toll that we pay along the way will also depend on how effectively 3 elements of the government's economic policy response, support for workers, support for businesses, and the health service, can operate to protect jobs, firms, and lives in the meantime. But what's clear even now is the toll this pandemic has taken on the public finances. While the government has not struggled to borrow what it needed to fight the virus and mitigate its economic effects, it has in the course of doing so already accumulated a stock of debt 3 times higher than we had 20 years ago. And while the interest rates we're paying on that debt are 1/6 what they were at the turn of the century, there are no guarantees that they'll remain so. Indeed, history warns that interest rate rises can happen much faster than debt can fall. And the shortening of the effective maturity of our debts has left the public finances more exposed to a sudden rebound in interest rates. What future fiscal adjustment will ultimately be required to restore the nation's public finances to health and ensure our resilience to the next crisis depends in no small part in how well we can manage this one. Well, what we can say at this stage, based on our central forecast, is that while the Chancellor's spending review has made a £10 billion down payment on that adjustment, A further 20 to 30 billion pounds will be needed to meet the loosest conventional definition of balancing the books and arrest the rise in the underlying debt to GDP ratio by the end of the forecast horizon. Thank you very much for your attention, and with that, we'll now turn to your questions.